What if I told you that the way your bank works today isn't new at all? That every loan, every interest rate, every financial crisis has roots that go back thousands of years, crafted by hands you've never heard of. Modern bankers might think they're inventing the future, but in truth, they're following a blueprint written centuries ago. A blueprint that has survived wars, empires, and economic collapses. And here's the twist. The very flaws that haunt us today were already present in the ancient system. Pause for effect. Ancient Mesopotamian clay tablets, coins, early marketplaces. To understand this ancient blueprint, we must travel back over 4,000 years to Mesopotamia, the cradle of civilization. Here, the first proto-banks weren't in skyscrapers, but in temples. The priests of yore and Babylon didn't just oversee religious rituals, they managed grain, silver, and loans. Farmers who needed seeds or tools borrowed from these temple banks, agreeing to repay with interest. Sounds familiar? It should. Understand the system that enforces it was already in place. Fast forward a few centuries to medieval Italy, and we meet the Medici family. Florence in the 15th century was a financial powerhouse. The Medici didn't just lend money, they innovated accounting, letters of credit, and complex financial instruments that allowed trade to flourish across Europe. Their genius wasn't just in wealth, it was in control. They discovered a secret still practiced today: leverage. Borrow a little, control a lot. Renaissance-era ledgers, gold coins, merchants in marketplaces. But the blueprint had a hidden flaw, and that flaw would ripple through history, creating crises that seemed new but were anything but. Animated timeline from Mesopotamia to Florence, showing evolution of banking practices. The ancient blueprint is simple in concept, yet profound in impact. Step 1. Gather deposits. Step 2. Lend those deposits at interest. Step 3. Leverage borrowed capital to expand power. Step 4. Repeat endlessly. This formula gave rise to prosperity and greed. In Mesopotamia, a failed harvest meant a borrower couldn't repay a loan, and suddenly the system teetered. In Renaissance Florence, risky loans to princes or trade expeditions sometimes collapsed. But here's the critical point. In both cases, bankers weren't punished for failure. They were insulated by systemic structures. Temple authorities in Babylon and the Medici in Florence knew how to shift risk, concentrate wealth, and protect themselves. This, in essence, is the DNA of modern banking. 17th century Amsterdam, the first stock exchanges, bustling port cities. The blueprint grew with the rise of global trade. Amsterdam became the world's financial capital in the 1600s, home to the first stock exchange and early joint stock companies. Here, risk and reward were separated in new ways. Investors could gamble on ventures while spreading risk across many backers. Banks became central to this system, providing liquidity, financing fleets, and even backing governments. By the 18th century, London and Paris were following the same model. Governments borrowed to fight wars, banks lent with interest. The system thrived as long as confidence held. The blueprint was becoming universal, but history had a pattern. When confidence broke, chaos followed it, and break it did. From the tulip mania in Holland to the South Sea bubble in England, and eventually the Great Depression in the 20th century, the blueprint revealed its fragility. In each case, the same story repeated: over-leverage, risky speculation, overconfidence, and systemic protections that shielded elites while ordinary people suffered. Governments tried to intervene: regulations, central banks, bailouts, but the fundamental architecture remained untouched. Why? Because the blueprint was resilient. It was designed not for fairness, but for survival, for the accumulation of capital and the protection of those who control it. And that resilience explains why modern bankers still follow the same patterns. Modern banks, Wall Street, digital transactions, financial news headlines. Look at 2008 subprime mortgages, securitized debt, and credit default swaps. These sound like modern inventions, but they echo ancient principles. Lending beyond means, spreading risk, protecting insiders. Even today, trillions of dollars circulate through systems built on the same blueprint: deposit, lend, leverage, protect. Shocking data. In the US, banks hold over $25 trillion in assets, with leverage ratios strikingly similar to those seen in medieval Florence, meaning the same vulnerabilities remain. Financial crises aren't anomalies, they are recurring events, echoing a 4,000-year-old design. This isn't just history, it's a mirror. Every bailout, every policy tweak, every innovation in finance is a variation on a theme that began in temples and palaces, and still governs our global economy. Bullet points over relevant visuals. So, what can we learn from this ancient blueprint? Human behavior repeats itself. Greed, overconfidence, and risk-taking haven't changed, only the technology we use. Systems protect the powerful. Structural advantages favor elites, making crises almost inevitable for the rest. Understanding past patterns gives us foresight, because if you ignore 4,000 years of banking history, you're doomed to repeat it. Fade to modern city skyline at night. Banks glowing, subtle tension music. The blueprint is still alive today. Modern bankers might deny it. Regulators might hope to control it. But the fundamental architecture persists. And as technology accelerates AI, digital currencies, global markets, the ancient rules will manifest in new forms. Are we prepared to recognize the signs before the next collapse? If this story surprised you, made you question everything you thought about money and banking, subscribe and hit the bell. Because understanding the past isn't just about history, it's about survival in a world still ruled by ancient blueprints.